And a lot of people who push back against this thesis say, well, the BRICS don't have a bond market and the bond market is still the most liquid. And where do you put your reserves? Well, I'll tell you where you put your reserves. First and foremost, they have been putting them into gold. And if you go back 25 years, gold has doubled the performance of the bond market. It's averaged 9.9% compounding per year for the last 25 years. But what it doesn't have is counterparty risk. So when you look at all of these bilateral agreements, if we go back to the meeting in South Africa last year, that was that was the plan. That was, go back to the drawing board. We still need to talk about how we reach a common settlement currency. And I want to talk about that for a moment because James Rickards has a very interesting take on that, and I agree with it. But in the meantime, let's all trade in local currencies where, China just canceled big orders for grain from Australia and the United States, replacing it with orders from Brazil, the second largest producer or exporter of corn in the world and a big a grain producer, and they will take yuan for the payment, not in dollars. That chips away at the dollar settlement, and then the reserves would then be put into gold instead of U.S. treasuries, which have a better track record and have no counterparty liability. But this is being seen everywhere, whether it be between Iran and China, or as you mentioned earlier, between China and the United Arab Emirates, or between Russia and India. All these countries are trading in local currencies. That chips away at the dollar settlement status. The reserve status gets chipped away when we see these countries shedding treasuries, like we've seen. China's down to just over 700 billion in treasuries from almost 3 trillion, and their gold holdings have increased, other than this month, which has remained stagnant for 19 straight months in a row. That's indicative of all of these countries in the Southern Hemisphere. They are slowly and methodically detreasurizing and accumulating gold and foreign or commodities in replacement. And I really do believe that these commodities, as Zoltan Pozsar calls Bretton Woods 3, a system backed by commodities, have become more valuable than the currencies that they're being bought with. And so the lack of treasury settlement is really the key. And I think this is the one thing that the people the dollar bulls and the recency bias, normalcy bias people are missing. And yes, there isn't something like the bond market yet, but I think gold represents not only, think about it. Treasuries represent but a very small sliver of history in terms of other countries accepting a country's debt as an asset. But gold has a 5,000-year history of that, as do all of these commodities. There's an old saying, he who has the commodity, or the gold rather, makes the rules. And this flow of commodities, in particular gold and silver, from the west to the east is being massively underestimated. And I think that underestimation of the significance of that is a very, very big Achilles heel. This is something where these countries, I believe, are looking to commodities to replace, in particular gold, which is the only other tier 1 reserve asset, as mandated by the BIS in 2019. Look at the massive accumulation of gold by all of these Southern Hemisphere countries and the slow de-dollarization and de-treasurization. They are trading treasuries and dollars for commodities that cannot be weaponized or inflated away. And that's really, gold is the issue here, and it's being overlooked.
A lot of people who push back against this thesis say, well, the BRICS don't have a bond market, and the bond market is still the most liquid. Where do you put your reserves? Well, I'll tell you where you put your reserves. First and foremost, they have been putting them into gold. If you go back 25 years, gold has doubled the performance of the bond market. It's averaged 99.9% compounding per year for the last 25 years. What it doesn't have is counterparty risk. When you look at all these bilateral agreements, if we go back to the meeting in South Africa last year, that was the plan. Go back to the drawing board. We still need to talk about how we reach a common settlement currency. James Rickards has a very interesting take on that, and I agree with it. In the meantime, let's all trade in local currencies. China just canceled big orders for grain from Australia and the United States, replacing them with orders from Brazil, the second largest exporter of corn in the world. Brazil will take UN for the payment, not dollars. This chips away at the dollar settlement. The reserves are then put into gold instead of US treasuries, which have a better track record and no counterparty liability. This is being seen everywhere, whether it's between Iran and China, China and the United Arab Emirates, or Russia and India. All these countries are trading in local currencies, chipping away at the dollar settlement status. The reserve status gets chipped away when we see these countries shedding treasuries. China's down to just over $700 billion in treasuries from almost $3 trillion, and their gold holdings have increased. For 19 straight months, their gold holdings have remained stagnant, which is indicative of all these southern hemisphere countries. They are slowly and methodically de-treasurizing and accumulating gold and commodities in replacement. I believe that these commodities, as Zoltan Passer calls Bretton Woods III, a system backed by commodities, have become more valuable than the currencies they're being bought with. The lack of treasury settlement is really the key. This is the one thing that the dollar bulls and the recency-biased people are missing. There isn't something like the bond market yet, but I think gold represents not only stability, but a very small sliver of history. Treasuries represent a very small part of history in terms of other countries accepting a country's debt as an asset. Gold has a 5,000-year history of that, as do all these commodities. There's an old saying, "He who has the gold makes the rules." The flow of commodities, particularly gold and silver, from the west to the east is being massively underestimated. The underestimation of this significance is a very big Achilles heel. These countries are looking to commodities, particularly gold, to replace their reserves. Gold is the only other Tier 1 reserve asset as mandated by the BIS in 2019. Look at the massive accumulation of gold by all these southern hemisphere countries and the slow de-dollarization and de-treasurization. They are trading treasuries in dollars for commodities that cannot be weaponized or inflated away. That's really the key issue here, and it's being overlooked. Every country on the planet has had to stockpile dollars for the last 50 years in order to buy oil. The significance of that is extraordinary, almost as extraordinary as taking the reserves and putting them into treasuries, which solidified the reserve status of the dollar. This status is being challenged by all these bilateral deals where countries trade in local currencies. What is the incentive for countries to hold our dollars, which are being inflated away at a rate of $1 trillion in debt every single 100 days? What used to take 200 years to accumulate $1 trillion, we now do in 100 days. A government that has chosen the weaponization of assets of the treasury and the dollar is losing its ideological alignment with other countries.
Yeah, so every country on the planet's had to stockpile dollars for the last 50 years in order to buy oil. The significance of that is extraordinary, almost as extraordinary as taking the reserves, the excess, and putting it into treasuries, which is the reserve status of the dollar. The settlement status of the dollar, where every country needed to own it and stockpile it in order to buy oil, is certainly being challenged by all of these deals that are being done bilaterally, where countries will trade with one another in local currencies. And this is a huge deal. In other words, what is the incentive of countries to hold our dollars, which are being inflated away at a rate of $1 trillion in debt every single 100 days? What used to take 200 years to accumulate $1 trillion, now we're doing it in 100 days. And a government that has chosen weaponization of the treasury and the dollar if we don't align ideologically. So the incentive of these countries who have been forced into holding dollars and stockpiling them, creating a synthetic demand, you could argue is no longer in place. Now, how fast does this unwind is the big question, but yeah, it's very, very, very significant. The reason the dollar was called the petrodollar, the reason that it had such great privilege and the hegemony, if you will, was created because everyone had to own it in order to buy oil. And oil makes the world go round. You take that away, and what is behind the dollar, it becomes truly fiat, backed by nothing whatsoever. But as Putin has recently said in a conference, the confidence of the United States economy. And I have to, add to that the confidence of the United States government. And you ask yourself, is that waning? I'll leave that up to people to decide. I'm sure we'll talk about that as this interview goes on. As those dollars, there are way more dollars outside the U.S. than are inside the U.S. because of the stockpiling to buy oil for 50 years. And as those dollars come home and are sold back to the issuer because no one wants to hold them anymore. Now, it hasn't turned out into a full-fledged dumping, which I could see it turning into that at some point. But there still is demand for the dollar. As you mentioned, still does represent 58% of global reserves, and there is dollar-denominated debt that needs to be paid off. But little by little by little, I call it logarithmic decay. Little by little by little by little, it starts to chip away as those dollars are there's no longer a necessity to hold them. And as those dollars start to come home, inflation rates would go higher and higher and higher and higher, and heaven forbid it's dumping. There's something out there called Project Sandman that basically says there's a whole group of 150, 175 countries that have agreed to do just that, to dump dollars in treasuries at a predetermined time. The question is it orderly or is it chaotic? But as those dollars come home, the level of inflation rises as those currency units are added to the currency base here, which would then raise interest rates. And that's the big thing that I've always talked about, is that Powell doesn't want to raise rates, doesn't want to let the 10-year treasury get above 5% because of the over-leveraged system, in particular the banks and the broker or the insurance companies that are massively over-leveraged and undercapitalized. And as rates rise, and supposedly this magic number is at 5% on the 10-year treasury, things start to break. Now, if all of a sudden the world is no longer holding dollars and in fact forsaking and dumping them and throwing them back to the issuer, creating much, much higher inflation than the CPI would probably tell us, the market would demand a higher interest rate to compensate for that loss of purchasing power. You can't have double-digit inflation and single-digit interest rates. Your currency dies. So interest rates would rise to meet that loss in purchasing power, to compensate for that. And when that happens, that's when you start to get into problems.
As we continue to explore the shifting dynamics in global finance, it's crucial to understand the role of gold and silver in this evolving landscape. The consistent accumulation of these precious metals by central banks worldwide is a telling indicator of where we are headed. Central banks are not just passively holding gold, they are actively increasing their reserves. This strategic move speaks volumes about their understanding of the current and future economic environment. Historically, gold has always been a safe haven during times of economic uncertainty. It's not just about the potential for price appreciation, but about preserving wealth. Unlike fiat currencies, which can be printed at will, gold's supply is finite. This intrinsic value makes it an excellent hedge against inflation and currency devaluation. In a world where paper currencies are losing purchasing power at an alarming rate, holding gold becomes a logical choice. Let's delve deeper into the relationship between gold and inflation. A rising gold price is a clear indication of a failing currency. When central banks print money to stimulate the economy, it leads to inflation, eroding the purchasing power of the currency. Gold, on the other hand, maintains its value. This is why, during hyperinflationary periods, gold prices soar as people flock to it to preserve their wealth. But it's not just gold that plays a crucial role. Silver is equally significant. Often referred to as poor man's gold, silver has a dual role as both an industrial metal and a monetary asset. Its use in various industries, from electronics to solar panels, ensures a steady demand. Moreover, during times of economic turmoil, silver often outperforms gold. This dual demand makes silver a versatile asset for any investment portfolio. Consider the current situation with silver. Despite its industrial uses, the price of silver has been suppressed, much like gold. The creation of paper silver through various financial instruments has artificially kept the price low. However, this suppression can now not last forever. As more investors seek physical silver, the demand will outstrip the supply, leading to a significant price surge. Smart money understands this and is accumulating silver aggressively. Now let's talk about the broader implications of these trends. The move towards gold and silver by central banks and savvy investors indicates a lack of confidence in the global financial system. The traditional reliance on fiat currencies and government bonds is waning. Countries are seeking to reduce their exposure to the US dollar and other major currencies, which they view as increasingly unstable. This shift is not just about economics, but also about geopolitics. The BRICS nations, Brazil, Russia, India, China, and South Africa, are leading this charge. These countries are looking to reduce their dependency on the US dollar for international trade. By creating bilateral agreements to trade in local currencies and accumulating gold, they are slowly but surely moving away from the dollar-dominated system. A key component of this strategy is the accumulation of commodities. Commodities, unlike fiat currencies, have intrinsic value. They cannot be printed or artificially inflated. This makes them an ideal store of value. As Andy Schectman points out, countries are increasingly viewing commodities, especially gold, as a safer alternative to holding US dollars. The implications of this shift are profound. If the trend continues, we could see a significant revaluation of gold and silver. As the demand for these metals increases, their prices will rise, reflecting their true value as safe haven assets. This revaluation will have ripple effects across the global economy. For investors, this represents an opportunity to protect and grow their wealth in uncertain times. Moreover, the move away from the US dollar could lead to higher inflation rates in the United States. As countries dump their dollar reserves, the excess dollars will flow back into the US economy, increasing the money supply and driving up prices. This scenario underscores the importance of holding assets that can preserve purchasing power, such as gold and silver. In this context, it's essential for individuals to take proactive steps. Diversifying your portfolio to include physical gold and silver can provide a hedge against inflation and currency devaluation. It's not just about preserving wealth, but also about ensuring financial security in the face of potential economic upheaval. Additionally, understanding the patterns and trends in the market can help investors make informed decisions. Recognizing the signs of a failing currency and the strategic moves of central banks can provide valuable insights. It's about being ahead of the curve and positioning yourself to benefit from these trends. Let's take a moment to reflect on history. In 1913, you could buy 11 loaves of bread with $1, a silver dollar, or a $1 gold coin. Today, that same dollar bill might buy you a quarter of a loaf, while the silver dollar could still buy 11 loaves, and the gold coin significantly more. This historical perspective highlights the enduring value of gold and silver as stores of wealth. The current economic environment is reminiscent of past periods of monetary transition. The move away from a gold standard in 1971 marked a significant shift in the global financial system. Today, we are witnessing another transition, this time driven by the erosion of confidence in fiat currencies and the growing importance of commodities. For viewers, it's crucial to stay informed and take action. Investing in physical gold and silver is not just about potential profits, but about securing your financial future. As central banks and savvy investors accumulate these metals, it's clear that they understand the strategic importance of holding tangible assets in uncertain times. In these uncertain times, it's vital for American and allied citizens to recognize the shifting dynamics of global finance. The traditional financial system is under pressure, and the stability of fiat currencies is increasingly in question. By investing in physical gold and silver, you can protect your wealth from the erosive effects of inflation and currency devaluation. Moreover, building a community around shared values and resources can provide additional security and resilience. Together, we can navigate these challenges and secure a stable financial future. Remember, in times of change, those who are prepared will thrive.
If you want to stay most up-to-date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.